With it on both ends. As a matter of fact, we are supposed to be using a new platform, Calum.
The pandemic as usual, but
You're not talking, man, but you're not hearing me. You're just not talking yet. Everybody, come on, continue. What is Charmaine doing in this class? Charmaine Thomas, what are you doing here? Charmaine, what are you doing inside this class? Charmaine Thomas?
Yes, sir.
You should not be here, you know.
Okay, okay.
Get out. What are you doing here? You're eavesdropping, man. You want to listen to me, Charmaine? In Charmaine? She gone. All right, let's continue now. Let's continue. One of the persons. So we did the first one a while ago where we look at the one for this one, right? No. I'm missing who me can call upon. Jodine Lawrence, your time. Speak up. How should we approach this one? But goes and credit from W1 420. What two accounts will be affected here?
Why Young and Cash for the goods?
No, why Young and no man. Say, well, shut the
You
film.
know.
No man, say bought goods and credits. Alright. When you say bought goods and credit, you mean purchases here. Here. When you say sold goods and credit or sold
Okay.
goods, you mean sales, okay? When you say bought goods, you mean what? Purchases. And when you say sold goods, you mean what? Sales. Good. Alright, for this one,
Explain it based off of how me understand it.
make it. But they say bought goods and credit, not cash. So bought goods and credit from double one, 420. Good. So you're gonna have two accounts affected here. The purchases account and also double Young's account, right? So watch this now. I did not go through, there's a thing I should have gone through with you before. I believe I should have gone through because asset of stock. But I did not go through that part. It was sorry, but still there. That part I should have gone through, but we'll go through next time. So bought goods and credit now, meaning you would mean purchases, right? And also double one. So double Young is now your creditor.
So would that be entered on your right answer?
All right. So double Young, as you relates to double Young,
Purchases. Sir, so your purchases is due.
you be a debit the purchase account, debit it. And you credit double Young because double Young is a liability to you now. And because liability is increasing, because you're buying on credit in the payment, you would have credited double Young's. Huh? I'm saying that credit, you'd have a credit entry to double Young's account because you're buying on credit. So you'd have incurred a liability. Anyways, let me look at the working out for you. We should working out. All right, the working out shows that. Let me enter, folks. So for the working out now, you're gonna create two accounts. You're gonna create a purchase account. All right, please, if you're writing, please ensure that you leave some space below your cash account because you might have more transactions to go there, right? And also below your purchase account as well, okay? And just leave some space there. All right, so for purchases now, the date is 2008, it's the same. I think it's March 2. And the person name is Double Young. And you'd also create an account for Double Young as well. All right. So as I said, so in this case now you debit purchases, right? And the amount is see the amount is 420. So you're gonna debit purchases account with 420 and write Double Young because there's a relationship. I'm gonna credit Double Young's account now.
Double Young account, all right, purchase.
All right, purchases. And it'll be 420. Music.
How far Close eyes to my ear.
All right, so that's it for that.
Share. Yeah.
So your debit purchase account and credit W Young's account, right? Now, when you buy stocks or inventory, it is always purchases account affected, right? Right, so you don't have anything called a stock account. You have something called a purchase account, right? When you sell stock, it is what? Sales account affected, right? When you buy stock, your purchase account is affected. When you sell stock, your what? Sales account is affected, all right? Good. So in this case, you debit purchases and credit what? W Young. Because W Young is your what? Liability, meaning you're owing money. So and liability increase, and the rule says that when liabilities increase, you what? Make a what? Credit entry. Next question. March 3, paid rent by what? Cash, 210. All right, now anybody can answer this one a while ago.
So you make a,
Go ahead.
you would make
What?
a debit for the cash.
Is that what? That man?
So you would debit rent
Debit
and
rent.
credit cash.
Yes. Case and penalty. Remember that rent is a what? Expense, right? And you're paying by cash. Good. And your cash is what? Decreasing. And because your cash is an asset, and your cash is decreasing, you must what? Make a what? Credit entry in the cash account. So you're going to debit rent, meaning debit the rent account, and what? Credit the cash account. Good?
So, sir,
Yes, sir.
hear me now. So, if you are going to say now, you receive the rent, say you receive $140 by check, the
Yes.
rent. That
Yeah.
means, on the rent account, you credit the cash, and on the cash account, you debit the rent.
Quite so.
All right, my boss.
All right, cool. All right. So in this case, I paid rent by cash, right? All right. So now, two accounts are affected here: rent account and the cash account. Good. But the person who asked me a question a while ago, but there are two different accounts there. You have one for rent and you have one called rent receive. What you'd have had in your case would have been rent received, not rent. All right. In this case now.
All right, sir.
All right, good. You pay rent by cash now. So you would debit, you would debit the cash in the rent and you would credit the cash account with rent, so to speak. All right, so let's go to the. So paid rent by cash. So meaning your expenses are being what? Increased. So you debit the rent account and put in the cash in the rent, as in the name of cash under the rent account, and you would credit the cash account and put the name rent under the cash account. All right. Let's go now. The March 210, right? March 3. So you already have a cash account, right? So the only thing you need to do now is to create a what? Rent account. Good. I'm going to do it to this side over here. Copy. Paste over here. So you're going to rent account now. Rent account. In this case is what? March 3. Paying by cash. And the amount is 210. Your debit rent and what? Credit cash. 2008. March 3. and you write rent, and you write 210. So that's how they are done. Debit rent, credit cash for that transaction. All right, next one. All right, so what this one now? March 4 paid $6,000 of the cash of the business into our bank account. Now, in this case now, one asset is decreasing while the other is increasing. All right, let me ask somebody now. I miss you, can jump on now. So you go down to the next side. All right, now. All right, let me see now. Miss Kishan Michael, talk to me, please. She did it? She did it. Shashana, Shash.
Sir?
All right, talk to me. Which of these?
Sir, you're going to debit the bank account and credit cash.
Thank you very much, my dear. So you're going to debit bank and credit cash. Because you pay $600 of the cash of the business into the what? A bank account. Let's look at it now. So debit bank, credit cash. So currently, let me see now. We have a bank account already. All right. We have a cash account. Now we need to create a what? Bank account as well. Copy that and then you're gonna create the bank account right here. So let's call this down bank account. So you know, credit cash, right? March 4. And the amount is again 6,000, right? And you're gonna debit bank. It's 6,000. Now in account, this is called what you call a contract entry. But when you reach your cash book, you will let me see. When you reach the cash book, you will learn about that. About contract entry and those things, right? So therefore, you would have created cash account because you're paying the money from the cash to the bank and you debit bank. All right. And that will give you $6,000. All right. Credit cash, debit bank. All right, next one now. Any questions a while ago? You have to read the transactions carefully, all right, at all times. Okay. All right, next one now. Sold goods on credit to D on bar 192. I said something previously. I want to see if somebody could have picked up what I said. Sold goods on credit to D on bar. All right, let me check somebody now. Brianna Davis, talk to me. How we approach this one? Brianna Davis,
Yes, sir.
talk to me, please. And don't
Sir,
tell
is
me
that
say no, no.
purchases?
Huh? That no? Come on, come, talk to me, please. Me have more here. What I say? Look at it, please. Sold what? Goods on credit. What sold mean? When you say bought, it mean purchase. When you say sold, it mean sales.
Purchases?
No, not purchase there. It's sales.
Oh, sales.
Yes. So therefore, you'd have two accounts to be affected here. You'd have your sales account and also D on bar. Now, you're selling D on bar, some goods on credit, right?
Yes, sir.
That means that D on bar go own you. So D on bar now becomes your what? Debtor. Meaning he owe you money. Good?
Yes,
When you
sir.
sell goods on credit, mean you're doing a sales. And sales go what? Increase what? Revenue. Good?
Yes, sir.
And when revenue increase, you what? Make a credit entry. That's how you go.
Yes, sir.
Therefore, you would debit D on bar in this case and what? Credit sales. All right?
Yes, sir.
Let's go now. So you'd have to create two accounts here. You'd have to create a sales account and also D on bar account. I'm going to create two accounts down here now. So you create one for sales. So we can get some sales. And one for D on bar. So sales account now. And also you create an account for D on bar as well. D on bar now is your debtor, meaning he owe you money. Owe the business money. All right. So for sales, as I said a while ago, for sales now, you make a what? Credit entry.
Credit entry.
Because revenue is increasing, right? So 2008 March 5. And the person you're selling to is who? D on bar. So you're right, D on bar. Here, so. On the D on bar, you write sales. Because he might get the goods. When him go pay you, you go put a credit entry here. All right. So so do 192 and 192 here, so as well. Technically, you know, D on bar is an asset to you because it's a debtor. So therefore, that's why you debit his account, all right? All right. Let's go now. Say, everybody got it, by the way?
Yes, sir.
Any questions? before I move on. Any questions, any folks? All right, let's continue. I know. Next one, March. Board stationery, $25 paid by what? Check. See who can talk to me the one I know. Jody Lawrence, talk to me. Jody. Jody Lawrence. You can answer me. Jody. She can answer. All right. Jody. Audia. You're available? All right. She's not available.
Yes, sir. Me there.
All right. How do you work this one? March 7, bar stationery, $25 paying by check. Which two accounts are affected?
Check account and the capital.
No. Go again. Try again.
Sir.
No. You again. Bar stationery, paying by check. Remember, when you say pay by check, you mean bank here, not check, bank. So bank account and which account again, by the way? Which other one? You again.
Yeah, me a listen, sir.
So which account is affected? You have bank and this one. See it here.
Stationery.
Yes.
January.
So you have stationery account and what? Bank account. Now, Adia, which account would you debit and which account would you credit? Adia.
You would have debit stationery and credit the bank.
Yes. That's it. All right, thank you very much. So you have your debit stationery, credit bank. Somebody else also asked a question, by the way. Now, stationery is a fixed asset. So therefore, one asset is increasing while the other one is what? Decreasing. All right. So debit stationery, credit bank. Good. So you have to create a stationery account because I already have a bank account already, 25, right? March 7. So we already have a bank account already up here, so only we create our stationery account, right? Create a stationery account down here now. So stationery would be debited while the bank would be credited. March 7, you write bank right here, and the amount is 25. So debit stationery, and you credit what? Bank.
Sir.
Yes.
Sir, why wouldn't stationery fall under purchases? And you say when you buy something, purchases.
You're not reselling stationery. Because stationery is bought not for resale, but for use in the business. Unless you want bookshop you run. You there?
Okay, sir.
That's the reason why. You're not buying for resale, you're buying, it's bought to be used in the business. Okay?
So you should have said that, you should have made that clear, sir, before you.
Move on. Let me highlight it then. So,
Because maybe confuses us to sir.
yeah. So what do
It's
Let me go back to it.
confused here, so.
Now, when you say bought stationery, you never say about goods, remember that. Now, stationery is something that you use in the business. It's not bought for resale, unless it's a case where you have a bookshop where you sell stationery. But even that, in that case, you would not say bought stationery, it would say bought goods, and in brackets, they might write stationery. Good? However, when you say bought stationery, it means that you're buying a fixed asset, an asset to stay in the business over a period of time, to be used in the business. All right? Now, when you say sold goods, sorry, when you say bought goods, meaning you buy something for resale. So goods are purchased for what? Resale. But stationery in this case now, are what is bought to be used in the course of the business. All right? Not for resale. That's the reason why you would not call the account for this one purchase, but you call it stationery. And you're paying by check, so you're buying the stationery by check, meaning the asset of stationery is increasing, while the asset of bank is what? Decreasing. So stationery is a what? Fixed asset. Good? Good?
Yes, sir.
Clear? So debit stationery. Huh? Go ahead.
Nothing, sir.
All right. So debit stationery and credit what? Bank. Remember, stationery is a what? Fixed asset, not a what? It's a fixed asset. Remember that stationery is a what? Fixed asset, not a current, not goods. Two different things. All right. Now, March 11 now. So debit stationery account and credit what? Bank. I'll go back to it again to show you. So debit stationery account and credit your what? Bank account. All right, next question now. Next transaction. Cash sales, $81. I'm going to this one now. When you say cash sales, it means that you have sold some goods for cash. So you have sold goods, you're receiving what? Cash.
Sir,
Now-
nah, you're clear now.
You hear me now? Are you hearing me? Are you hearing me?
Yes, sir. Yes, sir.
All right. Anyways, so goods for, now in this case, you'd have sold some goods for cash.
So, sir,
Yes.
so that means that the sales account now would have come a revenue. So that credit the cash, credit the sales account and the debit the cash.
Yes. Perfect, boss. Perfect. So in this case now, you would have debited the cash account and credit the sales account because you're receiving cash about sales and revenue. Huh?
Me not get that one there.
You have a person a while ago, the person said that sales is a revenue. So the revenue of sales is increasing. When the revenue increase, you make a what? Credit entry. However, your asset of cash is also increasing. And when the asset increase, you make a what? Debit entry. So in this case transaction, March 11, you have two accounts affected here. Sales and cash. You're going to debit cash and what? Credit sales. Because sales are revenue. Good? All right, let's look at it now. March 11. All right, so new share. So we already have a sales account and a cash account. So now, for this one now, you're gonna debit you're gonna credit sales first. It's March 11. And you're gonna put cash. And the amount is once again, the amount is $81. And you're gonna debit cash. Of sales. All right. So you debit cash with sales and credit sales with what? Cash. Because even though it's a cash sales, you're receiving cash. However, sales are what? Sales increase what? Revenue. And because the increase in revenue, you're gonna have to make a what? Credit entry under the sales account. All right. Good. So see there, this one, and also this one. You see that? Notice I did not create any additional accounts. I just use whatever accounts that exist already. All right. All right. Look at the next one again now. All right, goods returned by us to W Young, 54. Now, I'm gonna explain something to you now. I should have started it before, but I did not go through that part. Appropriately just. Anyways, whenever you see this called goods returned by us, that means that it's called return outwards, right? Good. Whenever you see anything called, if look at March 22, please. So the unbar return goods to us. That is called return inwards. When you see goods returned by us to a creditor, this is called what? Return outwards. When you see return to us, it's called what? Return what? Inwards. All right? Remember, going forward, again. Goods returned by us, return what? Outwards. Goods returned to us, return what? Inwards. Good? All right. Anyways, for this one now, it's a good return by us to W Young. I'll do this one for you. Now, when it's a good return by us, it means return outward. By the way, we have 3 minutes left. You want to re-log in or not? Tell me.
I will finish them.
All right. So you're gonna ask you to re-log in as soon as possible. Yeah? Re-log in, please. Okay. This will be your last re-log in for today. Re-log in so we can.
Sir, excuse me, I can't repeat. Sir, I can't repeat.
When you re-log
can you
in,
repeat what you say?
When you re-log in, wait now. When you re-log in, this one me left. When you re-log in, please. When you re-log in, yeah? Less than 1 minute, we can't do it so fast. When you re-log in. Remind me to do it, please.